is a very special session that we have coming up next. We are talking about supercharging sustainable finance through data, and which company would be better than one of the biggest in global data. We're joined by David Craig, who is the Chief Executive Officer at Refinitiv. As a company whose business is data all the way, it has a very positive contribution to make when it comes to measuring the impact of climate change and sustainability frameworks. This session will be moderated by Dr. Rian Murray-Thomas, who is Chief Executive at the Green Finance Institute.
Thank you so much, and welcome to our fireside chat during this day 3 of the Impact Summit here at the Singapore FinTech Festival. I'm delighted to be joined by David Craig, the Chief Executive of Refinitiv, and I'm Rian Murray-Thomas, Chief Executive of the Green Finance Institute, the UK's principal forum for collaboration between the public and private sector for mobilising finance towards a net zero carbon and nature positive economy. Now, David and I have had a few conversations previously, and the two of us, I'm sure, could speak all afternoon, but sadly, we've only got 20 minutes. So I'm going to leap straight in with this first question for you, David, which is, how do you define sustainable finance? And how exactly do you think it can help solve some of the world's most pressing sustainability challenges?
Well, it's really great to see everyone and to see you, Rian, and thank you everyone for joining on this really important topic for all of us. And as you say, we're a data company, a data and analytics company, delivering data across the world. So sustainable finance is an incredibly important topic for financial markets. And of course, data and technology has a really large role to play in that. So what is sustainable finance? Well, it's the ability for financial markets to create the opportunity to divest away from the unsustainable parts of business, be they high carbon or damaging nature or impacts on society, to the more positive, sustainable areas of activity and business. So it could be transitionary finance. It could be what we know as traditionally ESG data that allows people to understand the companies and the funds and their ratings according to their emissions of carbons and how they touch the planet. So simply put, it's the ability for finance to redirect funds away from high carbon intensive and non-sustainable activities into more sustainable activities.
I like that definition. I personally often say it's embedding climate science into financial decision making that we make every day. But I think you're absolutely right to broaden it beyond climate so that we are including biodiversity and nature. And we'll get back to that topic, I hope. I wanted to ask what you think the key barriers to progressing faster, mobilizing more capital at pace and at scale. Where do you see the barriers?
I think the barriers are in quite a few areas. They're gradually being reduced, particularly around the areas of climate, which I think is becoming much more precise and much more measurement based. With the things like scope 1 and scope 2, scope 3, it's a lot easier now with these taxonomies to understand how a company or how a security, a bond or investment is operating towards that. But I think there are other areas where actually the taxonomies and the data sets are not as clear. We'll probably come on to a moment on biodiversity and nature. So I think it is about evolving the standards so that things are measurable. It's understanding how the data really works in reality according to what's really happening on the ground. And it's also about building, I think, trust in the products that are available now in sustainable investments to make sure that people really understand they are truly sustainable. There's not issues like greenwashing and other things under them. And I think there's a barrier around validation because, and we may come on to this in a moment, but the ability to then validate what's really happening on the ground with these investments and these companies and these instruments is also critical. The barriers are coming down. I think there's an interesting question, is it fast enough and is it quick enough? And I think that's the topic of our discussion, Rian, which is how do we turbocharge this kind of development?
Exactly. So I guess what is the role of financial technology in trying to turbocharge or supercharge that redeployment of capital?
Well, I think there are a couple of roles. One is to harnessing technology and data together to help investors, be they retail investors, the pension funds, or the asset managers creating products, to understand how do I redirect money into high carbon intensive or low nature supporting areas into the lower carbon areas. So how can technology and data play a role in doing that? We're all familiar with public disclosures of companies. We cover about 10,000 companies in the world, 80% of the world's market cap, and use technology and data to understand how to redirect finance away from high further into low. I also think technology and data plays a role in new product creation. Financial markets are incredibly innovative, and one of the most interesting things that I've seen in the last, particularly the 12 months that I've been talking to many of our customers, is how many new products they're creating around sustainable finance. For example, is there a different price for aluminium based on the way that the energy is consumed or produced for the aluminium smelter? So technology can play a really interesting role in creating new products and new areas that incorporate sustainable finance. And then last and not least, there's the area of measurement and validation. And here's where I think for the geeks amongst us, it gets very interesting. It looks at satellite data and plumes of carbon emission. It's small devices that are located on ships or other devices that look at emissions and things. So I think there's three roles that technology can really play. They're all evolving, particularly the last one. I think we're just at the beginning of that journey.
I liked your reference to the taxonomy. That is something, obviously here in Europe, we have the EU taxonomy. That's obviously a directory of what's seen as green and not green. And that sometimes comes in for some criticism, saying obviously the science moves quickly, and is it really the role of politicians and possibly bureaucrats to come up, and really that's the role of the markets to come up with sort of these types of solutions. I'm personally a fan of having a taxonomy and a list, and I do think that it does lead to innovation. As somebody who created a whole suite of green products in my previous role in banking and is tasked with doing that in my current role at the Institute. But I just wanted to just get your views on principles and rules-based innovation versus free markets.
Well, the argument for free markets, which I'm a natural supporter of, breaks down a little bit when we realize that the way that markets have invested and operated with industry for the last 160 years has probably caused this problem. Because at the moment, the free markets don't price in carbon and other damaging aspects correctly. They don't have a natural price for that. So whilst I would normally be an advocate for free markets, I actually think with where we are with the planet at the moment, there isn't the fair and right price for carbon. There isn't the fair and right price for issues that are concerning nature. So I would have to agree that intervention has to take place in some form, be it regulation or a tax on carbon, or other things. Otherwise, we won't make that movement. And frankly, I think the market understands that and is now pricing according to that. If there's anything we've seen in the last 12 months, even through the crisis, is this shift away from high carbon into lower carbon has already started, because I think the market is already seeing that if a carbon price hasn't already arrived or the regulation has not already come in place, it's probably coming soon. So you sort of see a intervention approach that then the free market is responding to at the moment.
I think there's something like 400 pieces of regulation to do with green finance, and that number is accelerating. So we're definitely seeing that sort of intervention. I think we're going to be in violent agreement on this call, David, which I'm sure is a bit of disappointment to some. But I like to say that, given enough time, the invisible hand of the market would probably grow its own green fingers. But the climate scientists are telling us we don't have the luxury of time, and therefore we're going to have to try and accelerate that, putting a price on those externalities.
Yeah, sorry, go on.
No, I was just going to say we've spoken so far only about carbon, and I was just going to, expand the conversation to include nature and biodiversity, which is even more complicated.
Yes.
Taxonomy on nature, I don't know. Where are we on that idea?
So I think, in fact, my observation, we've been collecting disclosure data and ESG and carbon data for over 12 years, and I've seen, in a way, when we first started doing it, the data was ahead of the problem. I think the problem is ahead of the data, for a simple reason that whilst taxonomies and methodology and a science-based approach has been developed for carbon, and the Scope 1, Scope 2, Scope 3, the relative disclosures you can make, you can argue people are still learning how to do that, is relatively well formed. In the area of nature, it's far less defined. I mean, and issues of biodiversity change by sector, by geography, by activity, and it's way more difficult to, I think, create global standards and taxonomies around that. And I know that there's work going on. I think you're chairing work right now to do this. So I'm very curious and interested to see how it develops. But the size and the complexity of the problem is far larger than the, if you like, the simple carbon problem that we have, because it's less measurable, or at least the measures have to be very different and to accommodate that.
Oh, absolutely. Biodiversity in Wales back home is very different to the challenges of biodiversity in Latin America, and it's also a matter of context. So whereas, you know, an excess of water in one geographical context will have certain risk implications, they'll be very different in others. So it isn't like carbon, where we have such, and obviously carbon isn't simple either, but it is relatively more simple in terms of measurement, and, you know, reducing carbon is a universal target. So thank you for mentioning the Task Force on Nature related financial disclosure. We're in a working group phase at the moment, trying to grapple with exactly these issues. We have over 110 members at the moment, trying to figure out what the scope should look like for the TNFD when it starts in earnest next year, obviously taking many lessons from the TCFD. I see that nature is going to be, expanding environmental beyond carbon to include other aspects of nature is going to be a big trend next year when we talk to sustainable and green finance. Do you see other things on the horizons, other things that your clients are asking about as well?
Well, I think they're starting to ask a lot more about nature, as you said, and it is more complex and harder to really understand than the relatively simpler topic of carbon. We're starting to see clients do a lot more work with us on screening for what we call green crime. So they're trying to understand, are the companies that they're investing in or doing business through their supply chains involved at all in some of the illegal aspects that affect the environment, and wildlife trafficking being just one of the most obvious, or illegal logging. So we're starting to see a lot more activity in that space as well. And we're starting to see a lot of clients be very interested in what we call putting the sustainable back in ESG. ESG has been very focused on the E and very focused on the G, but not much focused on real true sustainability, particularly in communities. We've announced our initiative with Fortune and Measure Up to put ethnicity into lots of companies' measures, so we really understand how truly diverse leadership teams are. So we're starting to see actually a movement that is incorporating far more areas than just carbon into the whole measurement of sustainable finance. And the word sustainability, which is associated traditionally with climate, actually being broadened to a lot more issues related to how an investment, how a company, how a project in infrastructure works with the environmental factors around it, be the employee base, the communities it touches, the assets it's using, or the resources it's using, or the emissions that it's creating. So a far broader, I think, approach to sustainability than what's traditionally been seen as climate. And it's quite challenging because a lot of this isn't black and white. Data loves to be black and white, but a lot of it isn't black and white. So a lot of clients actually say, look, give us the raw data, we'll create our own methodology so we can make the judgment. So there's different models that are emerging through the market, depending on what part of the market you're looking at the moment.
I'm fascinated by the green crime, and that's something that is gaining more traction. And I suppose something that's very data-led and quite requires that technology to support it.
Well, I think the challenge that companies understand is that they may have a clean sheet of activities that they're involved in, but every company has a vast, complex supply chain of other companies that they're using, be they supplying manufactured goods, be they supplying labor, or the goods, or the trafficking, or the other areas. We've seen this particularly increase in Asia, where supply chains tend to be more complex. We've seen it take off in areas like illegal fishing, for example, and a lot of our clients saying we just need to know. We just want to be sure that we're not working with someone who's committing this offence, because it's going to damage our reputation. It's going to be expensive to replace them. It's not in line with our ethics. And so in the area of sustainable finance, which we're in, it's actually one of our fastest growing areas, which is to assure people that they're not committing these offences, certainly not directly, but even indirectly through their supply chains. We're a member of the Task Force for Preventing Wildlife Trafficking, and many other groups around the world that are really trying to use data to help them understand this as well.
And that does touch on the whole supply chain topic. It touches on some of the spatial data, satellite data, verification, all the points that you made earlier on. And there is clearly a role for technology looking at how we verify the provenance of commodities through supply chains. I think that's a really interesting area. It's an area that we've certainly been working on here in the UK on a government-sponsored program, the Global Resource Initiative, looking at deforestation commodities, for example. And again, an area it's very complicated. Supply chains, by definition, are very complicated, but it's one where technology does look to be providing some of the answers.
Yeah, I think that's right. And I'm a firm believer that even though disclosures are important, and they will get better and are getting better, they support a certain part of the market, the big public companies in particular, but the millions of private companies aren't going to go through a whole disclosures regime. So I think then measurement using things like satellites, associating a carbon plume to a building, to then who owns the building, what is the investment in that building, those types of technologies are starting to take off. It's quite early days yet. Largely the satellite data is available. It's actually how do you then link and associate that with the underlying assets and link that back to the company. Those are the kinds of things that we're looking at, actually working with MAS at the moment on these type of initiatives as well, to figure out how you make that connection so that we're not reliant on a world where every company has to disclose, because we just don't think that's possible, and won't be able to happen in time. And it's much better to actually have that view of what's happening.
That's fascinating. We're certainly working with the University of Oxford on their Spatial Advisory Initiative, which is again looking at this challenge. I just wanted to go back just briefly to the point you were making about E, S, and the G. And one of the things that I see is in this otherwise torrid and tragic year with the coronavirus and the pandemic, one of the positives that is coming out of that, I think, is some of the reframing around green finance and green investment, which I think at the political level has previously been viewed as, by many governments, as a cost, and is now being seen increasingly as an opportunity for jobs creation, recovery. We hear a lot about building back better and green recovery. And I think that reframing of investing in a green and sustainable future as a way of creating jobs and a prosperous economy is a really welcome one. And it's one that I think business can really get behind. I was wondering if you're seeing that in some of your client interactions as well.
Yeah, we're seeing a couple of things. I mean, you're absolutely right, Rianne. We're seeing record green bond issuance. I think when I last time I looked at the figures, about 80 billion this year as the recovery money goes into green finance. So that's one area that we're definitely seeing. There's a very, in the last 12 months, we've seen particularly the sell side, following the buy side banks, create whole departments in investing in new green capabilities and green products and sustainable finance products. And there's almost like a little bit of an arms race, if you like, to get the talent on board for people who understand these areas and these investments, and frankly to advise clients as well. So my own observation of that is ESG and green finance has moved from being a rather sort of compliance activity a few years ago to mainstream into everything. And in fact, in our business, our view is that sustainable finance touches every single part of our business, be it our wealth management, our asset management, our trading, or our risk business. And for most of our clients, they would actually argue the same, that there isn't really a part of the business that this is not touching, and it's moved from being a kind of separate department to being core to the financial activity of the institution. And I think that's the way it's going to stay. And maybe the crisis accelerated that. Who knows? But certainly the figures would show that there's far more activity in this space than we've ever seen before, and it's certainly not abating and going away.
On that very, very positive and optimistic note that we are mainstreaming green finance into all our financial decision making and all our business units, I'd just like to thank you very much for joining me today and for this conversation, David. Thanks so much.
Thank you very much, Rianne. Thank you, everyone, for joining us.
And it was great to join you both. Our huge thanks to Dr. Thomas and David Craig from Refinitiv. And I'm really glad that you ended on a positive note, because there was clearly lots of points there that we need to action on how to ensure the Sustainable Development Goals and to make sure that they're not left behind during our reaction to this pandemic.